Hello, and welcome to another stock analysis on Stock Market Palantir. Don't forget to subscribe and drop your comments. Now, let's go hear our analysts.
Welcome to the Stock Market Palantir. Today we are going to talk about FRMI, FRMI Inc. NASDAQ ticker FRMI. It really entered the public market as the perfect example of a pure play derivative on the AI boom. Their whole value proposition was solving this escalating energy scarcity problem for hyperscalers through Project Matador, which is this extremely ambitious 11-gigawatt energy and data campus planned for the Texas Panhandle. The story, tied directly to AI demand, was just intoxicating.
And that intoxicating story ran headlong into a brick wall in December 2025. It resulted in a severe, acute liquidity event, to put it mildly. And to really grasp the scale of the destruction here, you have to remember the stock's recent history. Since its IPO back in October 2025, FRMI had traded as high as, $37? But in one single painful trading session, it shed about 40% of its market cap, dropping down closer to the $9 mark.
Right, and that steep, just brutal decline was driven by one single critical catalyst: the termination of the Advance in Aid of Construction Agreement, the AICA, with its would-be anchor tenant. That happened on December 11, 2025. And in the eyes of the street, that event immediately flipped the company from, what analysts were celebrating as a pre-revenue growth story into something much tougher, a distressed development play.
And that termination is exactly where the debate really begins. The central disagreement we're looking at today is whether this extreme valuation collapse is fundamentally justified, a necessary repricing based on losing that critical deal and the execution risk it exposed, or if the severity of the crash is really more attributable to, say, distortions in the market's microstructure and just a reactive psychology of speculative retail investors.
And I'm going to argue that while the fundamental risks are, of course, undeniable, the market's violent reaction, that 40% drop in one day, was disproportionate. It was exacerbated, and I would even say actively amplified by the mechanics of trading. A forensic analysis of the trading data really suggests that liquidity providers acted to maximize the downside for their own benefit, not just to reflect the underlying value.
And I'm going to argue that while the market reaction was violent, yes, it was ultimately a rational and necessary repricing of risk. The AICA was the market's only real proxy for proof of concept, and its sudden failure just strips the company of its near-term cash flow projections, creating a profound and, in my view, an entirely justifiable valuation vacuum.
Okay, so let's dig into those mechanics right away. If you analyze the trading data in the weeks leading up to that December crash, you find this persistent and statistically significant elevation in off-exchange short volume. It was consistently hovering between 65 and 69%. That level of dark pool volume is highly anomalous, and it points to a systemic process of distribution happening right under the market's nose.
65% short volume is, that's high. But what exactly does that process of distribution actually imply for the stock's price action?
It implies the active engagement of wholesale market makers who are aggressively supplying stock. They were systematically internalizing retail buy orders in that $15 to $25 range, often using their own inventory or just shorting to fill the demand. It's often called the short is long phenomenon. They're shorting to facilitate the long demand from the public. So they were effectively distributing all the risks selling high to the public right before the bad news about the AICA hit. Then where the news broke, the price collapse was maximized because these same intermediaries could just rapidly cover those now very profitable short positions, forcing all the retail investors who bought at the top into a panic liquidation. So the market structure here didn't just passively reflect the news, it actively amplified the speed and the magnitude of the crash.
That's an intriguing argument about amplification, but I'm coming at this from a completely different angle. I think the market drop was justified not by the trading venue, but by the commercial and technical reality the ICA represented. That 40% drop was rational because that agreement was widely assumed to mean that the anchor tenant, an investment-grade hyperscaler, had already sent its sophisticated engineering teams to vet the technical feasibility. The power access, the water sourcing, the connectivity.
But those cash flows hadn't actually materialized yet. The agreement was still just preparatory.
Exactly. And its termination suggests one of two very, very damaging scenarios. Either the commercial terms failed dramatically during the final negotiation, or, and this is far more damaging, insurmountable technical risks or timeline risks were uncovered during the tenant's due diligence. And the consequence of this failure for the valuation is just staggering. Management had explicitly guided that this single 1 gigawatt contract would deliver approximately $1.5 billion in annual revenue.
Right, and critically, about $1 billion in net operating income.
$1 billion in NOI, yes. For our listeners, that's the revenue minus operating expenses before interest and taxes. It's basically the immediate cash flow from operations. The evaporation of that entire near-term pipeline is a staggering loss. The valuation premium was based entirely on the discounted value of those future cash flows. Without that anchor tenant, the premium just vanishes. It leaves a severe and completely justifiable valuation vacuum that a 40% drop only began to fill.
I'll concede entirely on the severity of the revenue vacuum and, yeah, the loss of the premium. However, management's reaction to the termination, that demands scrutiny. It speaks directly to a loss of credibility, which arguably deepened the crash even more than the initial news itself.
Oh, I'm not convinced by their reasoning at all. Management claimed they opted to call their bluff when the tenant supposedly tried to change terms at the last minute. Look, this is a pre-revenue company. It has high cash burn, immense capital expenditure needs to build out Project Matador. When you look at the commercial dynamics, where does the leverage actually reside? It's squarely with the investment-grade, revenue-generating hyperscaler, not the developer who desperately needs a capital commitment.
I agree. This wasn't some strategic move showing strength. This was a catastrophic failure to close a foundational deal. It exposed acute execution risk, and it fundamentally moved the stock from carrying, say, improbable execution risks far in the future, to showing imminent failure risk today. That change in risk profile absolutely justifies a severe repricing.
If they truly called a bluff on $1 billion in annual NOI, it suggests a profound misjudgment.
That's a fair point, though I would frame it a little differently by focusing on the operational floor that actually remains. We've established the downside, but the project isn't entirely dead. Crucially, they did retain the electric service agreement, the ESA, with Southwestern Public Service Company, which is Xcel Energy.
That's a positive, yes.
That ESA is still in force. It secures up to 200 megawatts of capacity, with 86 megawatts scheduled for delivery in January 2026. Now, while 200 megawatts is, a small fraction of the 1 gigawatt promised by the lost tenant, it means the physical site retains fundamental power connectivity and grid access. This tangible operational asset provides a legitimate, calculable floor. My concern is that the 40% drop overshot that, implying the market priced the stock as if the entire amount of their project, ESA included, had just instantly vaporized.
But the market's focus is on the 11 gigawatt future, not the 200 megawatt down payment. That capacity is just operational momentum. It doesn't solve the fundamental valuation hole left by the anchor tenant leaving. But let's go back to your microstructure analysis, because I still maintain that the long-term capital structure constraints are a far deeper, unaddressed fundamental problem.
I understand the skepticism, but the microstructure realities dictated the speed of the collapse. I maintain the trading venue amplified the crash. We confirmed that 65 to 69% off-exchange short volume. And I want to refute the common retail misconception about some predatory short squeeze driving the price down. The official reported short interest is only 3.3% of the float, just 6.33 million shares, with a very low 1.89 days to cover.
Okay, so how does that official figure reconcile with your dark pool volume theory then?
It means the massive downward pressure wasn't driven by some concentrated short seller conspiracy. The crash was overwhelmingly driven by institutional and retail investors selling shares they already owned. Long liquidation, once the news hit. The high dark pool short volume just explains the mechanism by which the smart money used the market structure to distribute risk and then cover those tactical shorts cheaply when the panic selling accelerated. They maximized their profit on the way down. The news created the severity, the structure executed the crash efficiently.
I agree that the high volume amplified the velocity of the move, but the magnitude was still driven by the fundamental vacuum. And that vacuum, when you view it against the company's capital constraints, justifies a sustained low valuation. FRMI made the election to be taxed as a real estate investment trust, a REIT, starting with the short taxable year ending December 31st, 2025.
Which is typically a structure designed to provide maximum tax shelter for operating income.
Exactly, but for a data center developer of this scale, it's fundamentally constrained. A REIT is legally required to distribute at least 90% of its taxable income to shareholders. While FRMI has a 0% dividend yield today because it's losing money, the moment it becomes profitable, it is legally obligated to return nearly all of that profit to shareholders. This means it can't easily retain the billions in earnings it needs to internally fund the next phases of Project Matador to get to that planned 11 gigawatt scale.
So the very structure they chose for tax efficiency starves their capital-intensive growth plan of necessary retained earnings, forcing them to perpetually rely on external capital markets or debt?
Precisely. This structural constraint makes the success of any future financing round and every future anchor tenant deal absolutely critical. That fundamental dependence on outside funding justifies deep market skepticism about its ability to realize the full 11 gigawatt vision, regardless of how fast the long liquidation happened.
That's a critical structural weakness. Let's pivot now to the physical and political realities that are maintaining what's left of the valuation, which I believe is where psychology is completely overriding fundamentals.
I'd rather address the technical reality of the site first. The full 11 gigawatt scope relies heavily on massive nuclear capacity, somewhere in the range of 4 to 6 gigawatts. Any nuclear facility requires massive amounts of cooling water, and they chose to locate this facility in the arid Texas Panhandle, a region entirely reliant on the already stressed and depleting Ogallala Aquifer.
Although the company has tried to mitigate this with an MOU for hybrid dry-wet cooling towers to reduce water usage.
Which leads us directly to the rational discount. We have to define the levelized cost of energy, or LCOE, which is the net present cost of electricity generation over the project's life. Hybrid dry-wet cooling systems are significantly more expensive to build than traditional water-based systems, and they are notoriously less efficient during the hot summer months in Texas, which leads to decreased power output. This location necessitates engineering and higher capital costs and lower operational efficiency, which drives up the LCOE. The market must rationally discount a project that has inherently higher operating expenses baked into its core infrastructure.
That is a concrete argument for a rational, sustained discount based on physical constraints. However, to understand why the valuation hasn't completely collapsed to pure liquidation value, why there's still a floor around $9, we have to look entirely at psychological drivers and speculative bets.
Are we talking about the grift narrative versus the moat narrative here?
Exactly. On one side, you have the grift narrative, the belief that the company is just an asset shell designed for politically connected insiders. But opposing this is an equally potent narrative that creates that floor, the corruption premium. This is the belief that co-founder Rick Perry's connections, what some investors call the Texas royalty factor, means the project is too politically important to fail because of the national priority of AI infrastructure.
That just sounds like pure political speculation, completely divorced from any technical and commercial diligence.
It is, but it's a powerful market force, especially since the company explicitly branded one section as the Donald J. Trump generating plant. This branding ties the stock into the so-called Trump trade, which, in this context, represents a speculative bet on a political put option. The bet is that potential federal intervention, say a massive Department of Energy Title 17 loan guarantee or something similar, could theoretically replace the lost anchor tenant funding regardless of the Panhandle's water risks or the high LCOE. This speculative political optimism effectively places an artificial floor on the stock.
We should also probably address the high level of investor confusion around the price action and valuation, which ties into both the rapid fall and retail sentiment. A lot of investors wonder if a reverse split took place, given the magnitude of the drop.
That's a necessary clarification.
We can confirm definitively that FRMI Inc. has not executed a reverse split since its IPO in October 2025. The confusion stems entirely from the pre-IPO corporate conversion, specifically the LLC to Inc. change, where membership interests were exchanged for common stock. The subsequent rapid price collapse, driven by the AICKA termination, it just mimics the profile of stocks that have performed reverse splits, misleading casual observers who are panicking based on charts alone.
That clarification is important, but it doesn't change the fundamental valuation tension we've been discussing.
And that tension remains our core disagreement. I see high velocity and excessive volatility driven by market structures that facilitated the effective rapid distribution of risk right before the bad news hit. The microstructure amplified the crash far beyond what the fundamentals alone warranted, essentially punishing the retail investors who were long.
And I see irrational, albeit severe, repricing based on the loss of a foundational $1.5 billion annual revenue pipeline and the exposure of critical unresolved technical risks, specifically that high LCOE, caused by the cooling solutions in the Panhandle, as well as the structural constraint of the REIT election.
We can certainly agree that FRMI is now officially a show-me story. For any kind of recovery toward its IPO valuation, it absolutely must replace that lost anchor tenant with a counterparty of equal credit quality, demonstrating that those technical risks were in fact surmountable.
A task that has become significantly harder given the very public failure of this first foundational deal. The idiosyncratic execution risk here remains extremely high and demands a continued discount.
We look forward to tracking how management navigates this unprecedented liquidity and credibility crisis in the coming quarters.
Absolutely.
Thank you very much for hearing us. Let us know in the comments what is your opinion. And if you want us to analyze other stocks, don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.